Welcome to Risk and Rewards on a week that was supposed to be sleepy. It was August and it was in the summer and it was mostly sleepy, except that today it got a little bit more exciting. I'm Lisa Abramowicz, John Authers here. As always, I am honored to be alongside him. John, a lot of interesting inflation data over the past 9 days or so. What are your inflation metrics showing?
The inflation metrics, so for the uninitiated, I have this heat map, a series of 35 indicators, which somebody in the Bloomberg marketing department decided to call the authors indicators, which I perhaps prefer they weren't called that, but there we go. And the idea is to give some sense by using the z-scores, i.e. how many standard deviations above or below the average for the last 10 years, all these different metrics that contribute to inflation are. And it is unquestionably broadening and suggesting that, yes, the inflationary pressure is ticking up. Today, we've had Atlanta Fed wage tracker information. So for the low-skilled, wage inflation is the highest in 10 years. Good news in a lot of ways, but inflationary. The Michigan consumer sentiment, which I think we're going to have to talk about because it's quite a shocker. But it also shows inflation expectations consolidating and rising at levels that we haven't seen in a decade. And of course, there's the actual CPI print, which I'm sure we were going to want to discuss.
Okay, so there are a lot of different components here. And I think that if we broaden out just to have an overview, the thing that I'm struck by is there's good inflation. When you talk about the Atlanta wage tracker, I think that's good inflation, right? We want wages to go up because that increases the buying power of consumers. And then there's bad inflation, at least when it comes to economic growth, and that's higher consumer prices without the offset of higher wages, right?
Yes.
And we've kind of been seeing this dual front. We've been seeing a hot labor market, good data on that front, good data Monday, Tuesday, Wednesday, even PPI seemed manageable, even though we got, much higher input costs into manufacturers. And then a Chinese port, a major thoroughfare for cargo ships, partially closed because of COVID. All of a sudden, it became very apparent that these supply chain disruptions were not going away anytime soon. And all of a sudden, inflation became more bad than good in terms of what people view it as. And I've been saying that in terms of the bond market expecting lower growth. And that's where the University of Michigan survey comes in and why it's had such a powerful punch when it came out today at 10 a.m. Eastern.
Yeah, and again, you don't, obviously as journalists, we've got to be careful not to feed into great degrees of concern, but this does have a stagflationary ring about it. People are getting really unhappy, and as the Michigan data admits of no other explanation, and all of us know why, because we really didn't think we were going to have to go through this COVID thing again, and because the adrenaline was up, we thought it was just something to all live through like the Blitz last year, and now it's just a drag. But when you've got low sentiment like that, and then you've got plain cost push, you've got real upward pressure on costs. That is a nasty combination.
Okay, so just for anyone who didn't see it, this consumer sentiment survey of University of Michigan showed it falling to the lowest in 11 years. And this was way below anybody's expectations. How much of this is politically driven by the fact that inflation has become a talking point, particularly people who are opposed to President Biden's agenda and passing some of the stimulus? That could very well be part of it, because that's increasingly a Republican talking point that inflation is going to harm the country. So increasingly, you're right that we don't want to weigh it on one side or another, and we don't know how much that's factoring into sentiment. On the flip side, you are seeing prices increasing, and that's not even including shrinkflation, where things are just a lot smaller, so you're getting less. But I'm looking at this mix, and I'm looking at the bond market reaction. We kind of got a retracement of some of the lows that we saw last week. Today, they're falling yet again, yields, and we're looking at a scenario that's more what you're talking about, stagflationary or stag-light. I mean, not stagflation, but slowing growth because of how high inflation is going. How does this dovetail into the Fed's call? Is this exactly what they expected?
I don't know. I don't think it is. Well, the one key thing that they weren't expecting, which none of the rest of us was expecting, was that COVID would come back with quite this much of a vengeance. And none of us should hold that against the Fed, because as we've all discovered, lots of us need to learn about something none of us ever had a reason to know very much about until early last year. Virology and epidemiology is not something you need to normally need to know about to get to be the top of the Fed. I assume you can only assume that this would that all else equal, because of the whole effect of demand on the economy, that people are going to be less enthused to go out and buy stuff. They're less able to go out and buy stuff because of the way things are, perceptibly shutting down again or slowing down again. That will delay the taper somewhat. Were it not for the Michigan sentiment, what we can see around us, everything points to some kind of announcement of taper, if not at Jackson Hole, then at the next FOMC. Not necessarily starting the taper immediately, but we've definitely talking about it. They're now going to be, I would have expected some fairly clear clarity about what was going to happen on a taper by the end of September, either through Jackson Hole or the FOMC. I'm now not so convinced they will be able to do that ultimately because of COVID, because of what we're living through.
In your decades of experience watching markets, John, have you ever seen a more binary potential outcome in terms of the people who come out, like Dean Kernet of Macro Advisors today on Bloomberg Surveillance, and he said, inflation is transitory, is the subprime is contained back in the day.
Oh,
and he wouldn't make calls. To be clear, he didn't follow it on by saying, so sell everything and get out of the market and sit in your hands. He said, we just don't know. And the market right now is discounting the potential for truly uncontainable inflation or much, much higher inflation than we currently experienced. And Jean Bovin of BlackRock Investment Institute agreed. We are not pricing that in at all. And yet if the indicators are showing that some of these disruptions, particularly on the supply chain side, have longer legs, which is what executives are saying. And you do see, employment statistics that could be skewed based on back to school trends and a whole host of other issues, including unemployment benefits. If that's not as transitory, or if that sticks around for a little bit longer, when do we need a mass repricing? Is it just sort of a, slow grind toward a new normal?
Well, it tends. In my. Thanks for reminding everybody. I do now have decades of experience looking at this.
So do I. So there you go, John.
The thing about bond markets and also about stock markets is that they tend to go up very steadily for long periods and down in terms of prices for bonds rather than yields, and down quite sharply and quite quickly. Think of the taper tantrum. Think of there was a big rise in yields in the summer of 2007 that in many ways broke the back of the subprime market. And I doubt, therefore, because that's not what bond markets do, that we'll get a gradual adjustment to something negative, to some bad news. You get gradual adjustments to good news, particularly, stock markets are a somewhat different animal there, but the taper tantrum was what we thought we were having a taper tantrum earlier this year, and we have totally reversed it. Like real yields actually went lower than the previous low. So that taper tantrum was completely pacified and calmed down. My best guess is that if this carries on much longer, if it becomes clear at some point, some inchoate point that, no, this really wasn't transitory, we'll get some kind of we will have an equivalent of the taper tantrum, more than a percentage point in a matter of weeks. That would make sense, because that's the way the market tends to go.
I'm thinking, because I'm just looking at the balance sheet of the Federal Reserve at $8.2 some odd trillion.
Yes.
Everyone who I speak to doesn't see it shrinking anytime soon. And if anything, it's going to keep expanding.
Yes.
And if the market were to sell off like that, why wouldn't the Fed just expand their balance sheet? They can't lower rates, right, from here unless they want to go negative. Yes. Why wouldn't they just go out there and suck it all up and, take all the bonds, suppress the yields even further? And so that's why when you look at the risk and the rewards, what if real yields go much more negative? Who's thinking about that? Right? I mean, who's thinking about the idea that we could see these inflationary pressures pick up? They're viewed negatively by the market.
And we end up carries on. And the real yield just carries on ever further down into the abyss.
Yes, because of the reaction function by the Federal Reserve. What other tools do they have at this point if they can't lower rates? It's ultimately going to lie more with their balance sheet.
I almost said the word Weimar. Sorry, I shouldn't say that.
Except you did.
I do not think we are not going to suffer Weimar style inflation. What I will say, I've spent most of this week, Sunday is the 50th anniversary of Richard Nixon ending the gold peg. And I've been writing about what differences it makes. And in many ways, it's surprising how little of a difference not being tied to gold anymore has made over the last 50 years. If we were still tied to gold, we would not be having this part of the conversation, because you wouldn't be allowed to do that.
Well, we're not tied to gold. Thank you, Richard Nixon, 50 years ago.
I question if inflation really takes off. I mean, the problem is there are no good, as we've said many times before, you actually do run out of historical precedents, not only in my professional lifetime, but ever. A central bank just keeps on buying bonds when it's obvious that nobody else otherwise would want to do so, because inflation is surging up. Well, they keep hurting the exchequer by doing it.
Well, hold on a second. But when you say that nobody wants to buy them, actually, foreign investors have been flooding in, because on a relative basis, the Fed's not alone, which is one reason why yields could remain as low as they are and continue to go lower. I'm not saying that I expect this to happen, right? I'm just saying that when you look at the backdrop of inflation and you look at the reaction function by the Fed, where people are so focused right now, how skewed are the risks to them actually expanding their balance sheet after, they might on the margin pull back some bond purchases, but I mean, what other tools do they have if things break?
Good question. I mean, the question is more, what would it mean for the system to break? Again, one of the fascinating things trying to work through the gold standards, 10 years ago, you had the S&P downgrade of treasuries. And in many ways, that was the point when Tina really took over, because this was, we got through 08 and Lehman by printing money, by the Fed borrowing. Everybody thinks this is going to lead to debasement, to inflation. Then the downgrade happens, and then you see what happens, and people take shelter in treasuries, from the risk to treasuries. And that was the moment that you could even call it the modern monetary theory notion that you really can, if you're the sovereign money printer, get away with doing this, with printing money. And okay, 2011 does look like quite a good test of it. You can downgrade the world's ultimate risk-free assets so that it's no longer risk-free and people want to buy even more of it. If you don't have that, then there are quite enough. As soon as people don't want to buy it, then you get into some very, very scary scenarios. So
we only have about a minute left. And I'm wondering, and I know, it's like we could talk about this all day, and this is, to me, the topic. But is the main risk that you see does it continue to be the potential for 10-year yields to rise by a percentage point, really quickly and derail a whole host of other assets that hinge on it?
Yes. That being said, I could probably have answered that question that way most of the time for the last decade or so. But yes, that's that.
I think we've lost John, which means that probably we should wrap it here. But we will be back next week with another edition of Risk and Rewards. No doubt we'll be speaking about inflation. No doubt there'll be a new angle on it and some new data ahead of the Jackson Hole meeting and what will happen with Fed officials.